18 will share the research with us. Arjun, good morning.
Well, good morning, Jeff. I just want to kick off with this sort of 5-year view of what's gone on. And we saw in the last cycle here, 2017, 2018, Bitcoin hitting highs of around 19,000 before a drop down to 3,000, which was around the bottom, an 80% drawdown. This time here, we've got at the moment a 70% fall. And there are differences in what has happened this time round versus last time. And three major issues. Firstly, the macro situation. Secondly, the collapse of a very key stablecoin. And thirdly, the massive leverage and lending we've seen in the sector. I'll just dig into the macroeconomy first. This time round, we've got rampant inflation and Fed on the tightening cycle. We've got the correlation between Bitcoin and stocks, and we know stocks have had a tough time, and that's why you're seeing Bitcoin and other cryptos under pressure as well, particularly as the macro environment worsens as well. Now, secondly, the stablecoin issues. I'm not talking about those stablecoins that are backed by reserves like Tether or USD Coin. I'm talking about Terra USD, an algorithmic stablecoin that massively collapsed, bringing down its sister token Luna with it, and that was big and sent shockwaves through the industry, really starting a lot of this contagion. Three Arrows Capital, a company I'll come on to shortly, had exposure to Terra USD, and that's where we begin to see this contagion story playing out. But the biggest difference between 2017, 18 and now was really around the leverage and lending picture as well. In 2017, 2018 cycle, the leverage very much was going to retail investors via exchanges. Those positions, when they couldn't meet the margin calls, were liquidated, and that was the end of the story. This cycle, everything is more interconnected. I'll kick off with Celsius. That was a company you were just talking about. This was a company offering about 18% yields to users who deposited their crypto with Celsius. What Celsius would then do is take that crypto, lend it out to other players in the industry in return for a high yield, and then try to give that back to their customers. But in doing so, took on risky bets and a lot of risk as well. They tried to pocket that yield to give back to investors, but the crash really tested that business model, which ultimately failed. The company having liquidity issue, paused withdrawals, and now has filed for bankruptcy. Next, Three Arrows Capital, a major hedge fund in the cryptocurrency space, known for bullish, highly levered bets as well. Now, they had several counterparties. Genesis and BlockFi, they reportedly missed margin calls for. They defaulted on a $660 million loan from Voyager Digital as well. They're exposed to the Terra USD collapse, and that really caused a lot of contagion across the industry. They plunged into liquidation, and now people are trying to get their money back, with the founders reportedly in hiding. And that's the big difference, the contagion we are seeing spreading across. Voyager Digital now having to file for Chapter 11 bankruptcy in the US, and there are others suffering losses. I think one thing we can say, that this cycle really has been characterized by poor risk management and some unsustainable business model, guys.